Hi, everybody. This is Aaron Oakes. I am a consultant and the project manager at JRG Advisors. And I want to welcome you to our Healthcare Reform Reporting Requirements webinar today. I also want to say a special welcome to all our clients and partners across the state of Pennsylvania, West Virginia, Ohio. I specifically want to thank all of you for your business and for your continued support through the various associations we represent, and I want to thank you for your business. A couple of housekeeping items before we get started. We are recording this presentation, this webinar, and we will be sharing the PowerPoint with all of you. So there's no need to take rapid notes. There's no need to screenshot or do anything like that. We will share all of this with you. And just to remind you, the phone lines are muted. So if you do have a question, you can always type your question in the right-hand side of the screen and then hit send, and we will receive the question. And we will cover questions at the end of this presentation. Also, we will be following up with this presentation with a list of questions and answers that we've collected. So just be patient with that, and you'll get everything you need to get through email. Today's agenda, we will be covering reporting requirements, obviously. This is the title of the webinar. We're going to go through a general overview. We're going to look at the importance and the impact of the requirements, what it means to you. We're also going to talk about penalties, which is fun. And we're going to talk about preparation and action items that we believe that most companies should be taking. Just a full disclosure before we get started. Obviously, JRG Advisors is a benefits consulting company. We are not a tax company or a legal representative. So this presentation is for informational purposes. If you have specific tax questions and or legal questions, I would encourage you to reach out to your respective representatives in those fields. Also, I wanted to bring up that most of this presentation and these requirements apply to companies that are deemed to be 50 full-time employees or above. However, if you are below that threshold, it is a possibility you would have to file if you are self-funded. And so, or if you expect your company to grow, and for general knowledge purposes, I do think it's important that companies of all sizes know what the requirements are for employers. So before we get into what the requirements are, I think it's important that we just talk a little bit about what is the purpose of all this reporting. So obviously, the Accountable Care Act is out there. It's been out there for several years. And of course, the government itself is in charge of monitoring the entire program. And by the government, you can boil that down to one agency that has the vast amount of tracking and responsibility for enforcement, and that is the Internal Revenue Service, the IRS. There are other agencies like the Department of Labor, Department of Health and Human Services that do have parts of this, but as far as an enforcement agency, the IRS has been deemed to be that service that will support this. And so, of course, how does the IRS know what you're doing as a company or as an employer? Well, you're going to have to report to them. And so that's where all this is driven from, and all the information is driving to. So why would the IRS, or why would they want to know what I'm doing? Well, they need to determine which full-time employees, if any, were offered coverage. Obviously, people that are in the United States and are required to have health insurance. And so you're either getting it through an employer or you're going to have to purchase it on your own in some kind of form, through the exchange or directly through an insurance company. And so the IRS needs to determine who did what. And so when they do that, they're going to reconcile with individual reporting to confirm eligibility for exchange subsidies. And so that's part of this entire reporting package. They need to also confirm that coverage was offered at least a 60% actuarial value, and confirm the coverage was affordable for employee. Part of course, the Accountable Care Act is affordability, and so therefore they have to determine that. And of course, if any of these tests are not met by an employer, then there's a penalty involved. As with anything else with the IRS, if you don't comply, there's a penalty, much like your taxes. Okay, so on this screen we're going to talk a little bit about the IRS, how they structure things, and what it means. And so you may have heard the sections referred to. And these would be Section 6055 and 6056. And this specifically deals with reporting, ACA reporting. And so what does that mean? Well, you may be familiar if you're in the HR business, the human resources business. You may have heard the term tossed around Section 125. That's also, that deals with cafeteria plans for benefit purposes. And that Section 125, for example, refers to Section 125 in the IRS code. Therefore, these codes of 6055 and 6056 are no different. It's just referring to a specific code or section within the IRS code itself. Now, 6055 deals with employer reporting of minimum essential coverage. And in other words, you may hear that referred to as MEC or MEC. The forms related to that are 1094B, which is a transmittal form, and 1095B, which is an informational return. Also, by extension, then we go to 6056, which is the employee statements of coverage, and that's what that section covers. And it's forms 1094C, which is a transmittal, and form 1095C, which is an informational return. And by the way, I will cover more into those forms in just a minute. And as I mentioned at the beginning of the presentation, much of this has to do with groups that are over 50. Now, of course, the code doesn't refer to it as groups over 50, quote unquote. What they refer to is something called an applicable large employer, or an ALE. An ALE is an employer with 50 or more full-time employees, which does include your full-time equivalents, which is also called an FTE, during the prior calendar year. You must begin reporting to the government, to the IRS, in 2016 for the 2015 benefit year, which is right now. So it already started as of January 1 of 2015. ALEs are required to do annual submissions. An informational return to the IRS has to be there by March 1st of 2016 or March 31st if you're filing electronically. So you get an extension if you do everything electronically. Information to employees has to get to them by January 31st. Now, giving to employees can also be provided electronically, and that goes with your W-2s as well. So if you're, however you're doing your W-2s today will probably suffice for this reporting to employees. Okay, now the good news with all this is most employers, and we will get into the nitty-gritties of this in a little bit, but most employers, most ALEs, will have to file a common form, which means you don't have to do the 1094B forms. You can do the 1094C for the transmittal and the 1095C for the employee statement. And again, I'm going to emphasize this applies to employers with 50 or more FTE and plus your FTE employees. There's no filing required if employer has no full-time employees. So that's important to note as well. As an example, we've included just what the 1094C looks like. You can see here this is the transmittal form. There's two basic parts to it. And there's the applicable large employer member, ALE member, basic information. Then down below you have Part 2, ALE member information. I'm not going to go through every part of this form. That would be something you would probably want to go through with your your accounting firm or your tax attorney. But this is an example of what it looks like. On the next page, you can see the 1095C. This is the employer-provided health insurance offer and coverage form, just to make it a long-winded explanation of that. You'll see there's three parts on here. There's Part 1, which is the employee itself, Part 2, employee offer and coverage, and then Part 3. Make sure you make a special note of that. That's for employers providing self-insured coverage, and we'll go into that in a little bit. But again, self-insured companies out there can use this form, and it would be Part 3 would be applicable to you. I think the most important thing, and if you've ever gone through the Internal Revenue Service or the IRS forms or codes, they are fairly complicated, and sometimes they can be vague, and sometimes they can be cryptic. I have gone through these sections several times myself, and they are vague, and they are cryptic. And so we're attempting here to make sense of these things. Keep in mind that the 6055, 6056 are the codes themselves, the sections of the codes. The forms are what are related to those sections. And so it's important to recognize that difference, that the forms don't actually represent anything more than a completion of the actions you're supposed to take related to those sections. I have also read several interpretations of these sections, and I have read conflicting interpretations of these sections. And therefore, the Internal Revenue Service came out on February 8th with final interpretations of this. And I think it's fairly clear, but I think the best way to represent this is through these. There's a couple of tables here we've constructed for you to kind of show what we're talking about. So on this screen, you'll see the code 6055 is reporting of health care coverage by health insurance issuers and sponsors of self-insured plans. So who's affected? Well, the effective employers would be the employers with self-insured health plans. The required information would be information on each individual provided with coverage, and that helps the IRS administer the ACA's individual mandate. So that's why you're doing it. The effective date, this was delayed until 2015, and so you don't have to file until 2016 on both 6055 and 6056. Now, under 6056, we're talking about applicable large employers, ALEs in other words, their health coverage reporting. And they're applicable large employers, ALEs, those with more than 50, that's what this section deals with. And it will cover all the terms and conditions of the health plan coverage offered to full-time employees. And what is that going to do? Well, that's going to help the IRS administer the ACA Employer Shared Responsibility Penalty. If you remember, that's in a separate section and covers, and it basically says what an employer has to do as an ALE as far as offering coverage. Now, this is a handy-dandy table we put together regarding the forms. So let's go from left to right. If you're an ALE that sponsors self-insured plans, what do you have to do? Basically, you have to complete both Form 1094C and both sections of Form 1095C. Remember that there's three sections on that actual form. There's one, which is just general information. There's two, and then there's three. What they're saying here is you have to complete both 2 and 3 if you're self-insured. Information under Section 6055 is about your health coverage provided. And it's also about information under 6056 about the offerings of health coverage to your employees. Okay, so let's move one to the right. You have ALEs that sponsor insured plans. What do I have to do? Well, you have to, again, you have to fill out Form 1094C, and then you have to fill out the sections of Form 1095C that are address the information under Section 6056, and that will satisfy the Section 6056, reporting requirements. These employers are not required to report under 6055. That's important to recognize. Remember when I said 6055 only has to do with self-insured employers and what we call a carrier or an insurance company, an issuer. So it doesn't apply, ALAs don't apply under 655 if you sponsor an insured plan. Okay. Now, non-ALEs, that's somebody that's not an applicable large employer that sponsors self-insured plans. And it's important to recognize that this is going to become more and more common. If you are under 50 lives, it's becoming more and more common to go to a self-insured plan. We have many, many clients with JRG that are looking at this option. The reason being is that smaller employers are being forced to make a decision. Eventually, the grandmothering, grandfathering, grandnephewing, whatever you want to call it, will go away. And so it will force a small group employer that is fully insured to go into something called ACA rating, member level rating. It's basically a standard way of underwriting those groups. And therefore, a lot of companies may experience some pain as far as rates jumping up quite a bit. You could also have an experience of the opposite effect where you may see your rates going down, but it's going to be more common for rates to go up. And so given that, and given the fact that in a self-insured environment you can be more flexible with benefits and other things, they're looking at that self-insured option. Now, if that occurs and you are under 50, that suddenly makes you part of the healthcare reporting law, and so you do have to file a couple things. If you're under 50, you're not an ALE, but you are self-insured, you do have to file Form 1094B and 1095B. Again, this is to satisfy Section 6055. So, lastly, if you are non-ALE, that means you're under 50 lives, and you sponsor an insured plan. None of this applies to you at this time. You don't have to comply with 6055, nor do you have to comply with 6056. That's the good news if you're a small group. So if I'm an employer, how do I actually report under 6056? Well, the first thing I would do is look if you can do electronic return filing. Reporting to the IRS, if you're using electronic filing, it's required. It is definitely required if you're submitting 250 or more returns, and that would be the specific form. Optional electronic filing for employers with fewer returns than 250 is available. Electronic furnishing of employee statements is permitted if notice and consent and the hardware and software are available under the requirements that are available under the W-2. So right now, if you have all of your consents and hardware and software that's necessary to deliver a W-2 electronically, that also applies to this regulation. Informational returns, it's basically the basis for the IRS to calculate applicable employer penalties. So you want to make sure you get this right. Or make a best effort, obviously. Okay, so the employer general reporting content to the IRS, I'm going to go quickly over what is required, what's not required. Under the required side, the things you're going to have to maintain and report include things like the employer information, main contact, the certification that minimum essential coverage was offered to each full-time employee by calendar month, so that everything boils down to calendar month. You have to keep that in mind. The number of full-time employees for each calendar month of calendar year, and then by employee, the month the coverage was available, the employee share of cost for the lowest cost plan that's available to them, and the employee information and months covered by the plan. Okay, so it's important to recognize that all these things have to be tracked. It's also important to recognize that if you're not tracking them, then you're kind of already behind at this point, so you want to be able to catch up. There's a lot of options to do this. You can obviously track on your own, but a lot of our clients are starting to work with third-party administrators through their payroll systems. A lot of different options are available to you out there. JRG itself strategically partners with some payroll companies, some TPA companies, and if you package all that, sometimes there's some advantageous pricing to that. So if you're not involved with a current way to do a lot of this tracking, then that's something that JRG could obviously talk to you about. It's important to recognize what's not required. So waiting period length, not required. Employer's share, not the employees, but the employer's share of premium cost is not required. The premium for lowest cost plan by coverage type, for example, the employee-only, family, that kind of thing, not required. The months that employees' dependents were covered by the plan, not required. So it's important to recognize what's not required just as much as it is what is required. So under the employer, the reporting method, the general reporting method, you have to file information returns using an EIN number. So that's not a surprise. The purpose of the reporting, again, is to reconcile eligibility for the premium tax credits and to determine if an employer penalty is there. If you do have a liability, then you're going to owe. I will go over what those penalties could be made up of, and so hang on and we'll get to that. The information to be reported for each employee would include was the minimum value coverage offered, and to whom, the total number of employees in each calendar month, and I'm kind of summarizing what I just said on the prior page, whether an employee's effective date of coverage was affected by permissible waiting periods by the calendar month. And so remember that all this has to do with how long waiting periods are allowed to be out there, and there are specific guidances on that. So if we look at the employee statement, it requires a separate statement to be issued for each and every employee, similar to a W-2. So it's important to recognize that. You can't just lump everything together and send it to everybody. It must be included, or must include the employer name, their address, and again, the EIN. A single combined form can be used to report Section 6055 and 6056, which I already talked about. Those two forms. You don't have to have separate forms for 55 and 56. You can use the C's, which we had just talked about. Also, a substitute form that includes the name, the same information, is permissible under certain guidelines. If you want more information on that, you would have to contact JRG or, of course, your tax counsel. The employee statement must be furnished, again, to the employee on or before January 31st of the year immediately following the year for the information that was furnished. So that's a complicated way of saying in 16 you have to give the information that was applicable in 15. So let's talk about the penalties. Everybody wants to know, well, if I do get hammered, what are we talking about? Well, reporting entity that fails to, what causes the penalty first? So it would be a reporting entity that fails to comply with Section 6055 or Section 6056 under the reporting requirements that we just went over. They may be subject to a general reporting penalty for two things: failure to file the correct information returns under the code, it's a different code, 6721, or failure to furnish correct payee statements, and that's under code section 6722. The penalty in general is $100 for each return up to $1.5 million per calendar year. So it's a big number. However, if you did show that you were trying to comply, penalties could be waived, it could be adjusted due to reasonable cause, and if it wasn't willful neglect. And that's very common in the IRS code. However, you can't bank on that, obviously. We recommend you go the full bore and report everything as you should, of course. Okay, so a lot of when I'm out talking to clients, a lot of times they're just saying, well, what do I have to do? Where do I have to focus immediately? The immediate focus is should be on a couple things. You need to determine and document your full-time employees and your full FTEs, or your equivalents, in other words. Are you a large or are you indeed a small employer? And that can get complicated. If you are in the service industries, for instance, or if you are in the consulting industries and you have people that are coming on and off your payroll constantly, that can become a challenge. And that's where it's important that you start to use your payroll system if you have one, and it becomes easier to track if you have a computer system that's actually tracking it for you. You need to develop a process and procedure for tracking and monitoring. So as part of all that, you need to track your hours of service. You need to determine the measurement period if you're going to use one of the safe harbor methods, which is covered in another section. You must maintain who must be offered coverage. And so you do have some employees you don't have to offer coverage, but who do you have to offer coverage to? And you have to know that. And of course, you have to know the waiting period eligibility and how long you're making people wait for that, and how long after they roll off, when can we put them on, that kind of thing. That all has to be tracked. So it's fairly complicated if you have a lot of turnover. Okay, so that was a very general kind of overview of the entire process. Again, if you have any specific questions, obviously you need to talk to your tax accountant. If your tax accountant does not know about these codes, then I would bring it up to them and see if there is an expert within their service to kind of work with you to make it happen. There are some legal entities or legal services out there that focus specifically on ACA compliance, and so there's some helpful things we could guide you in the right direction on this. Our next WebEd event is actually on Wednesday, May 13th, so hopefully it's here in Pennsylvania. I hope it's sunnier, warmer, baseball season, I hope. And that'll be at 10 a.m. And it's going to cover something called creative funding strategies, and it's going to be part one of a several-part series. This is going to cover FSAs, HRAs, HSAs, and applicable to all employers. And so as part of that, remember that a lot of these services are offered through third-party administrators and payroll services, HR services, and that kind of all links into your tracking of the information we just talked about. And so as you can see, as we build these webinars forward, as we learn, we're also creating building blocks. So it's a lot like, you know, the old arithmetic. You learn one thing, you build on it, and you get to the next thing. And so that's the way we're running these webinars, and I think it's going to be great as we build these forward, that everything will build, our knowledge base will build, and of course that will help you and your employees. Okay, with that, we do have questions out there, and if you have any further questions, make sure you type them in, and we will do our best to answer them.
The first question, what does actuarial value mean?
Okay, so the actuarial value is a term that's been out there for a couple years. It really has to do with out of the cost of your overall health care, for example, your insurance, how much of a particular, you can think of it this way, out of $100 that's spent on health care costs, how much does your insurance cover? And so if you have $100 worth of health care costs, an actuarial value of 60 would mean that the health insurance is covering about 60 cents on the dollar. So that's what that means.
The next question, please define self-insured plans.
Sure. Self-insured plans it's not new in the bigger industry. So if you are a large employer, you are most likely very aware of what a self-insured plan is. It's becoming available to employers down to the level of 10 employees. And so I haven't seen a lot move to that, but I have seen some in the 25 to 40 to 50 to 100 range, and it's going to be becoming very common. What it means is that you are, in fact, at that point, if you're self-insured, you are the insurer. So you, in fact, turn into more or less the insurance company at that point, and you are paying your own claims. Now, traditionally, that's a little scary if you're a small employer, where the claims obviously can fluctuate. And so you might have a month or a week where there's little claims coming through, but the next week you might have a heart attack claim come through, and you owe that. Now, there are a lot of great ways to mitigate that risk and make it more or less feel like a traditional insured product for you. For instance, you would put in stop-loss insurance, which, in fact, limits your capture higher level risk. And so it's becoming more and more common. It does give you a couple things. It gets you out of some of the taxes that are related to the ACA, and it also gets you some flexibility around your benefit structure, and it just gives you a lot more control of the information. For example, you get all your claims information at this point, so there's really no surprises when your quote-unquote renewal comes around. You already know what you spent. All the information's out there. It's a lot more transparent than in, say, a fully insured product. If you do have questions about that or interest in that, that happens to be one of my personal specialties, but at JRG does specialize in smaller group and larger group self-insured business. So if you have any questions further about that, please give us a ring.
The next question pertains to an employer under 50 full-time or full-time equivalent. What if a company changes from an insured plan to a self-insured plan mid-year around July? What information is required on the form? Would it include information earlier in the year?
Yes, it would. You'd be tracking, well, first of all, you need to track, because you're an ALE, regardless of whether you're insured or, was the question under 50?
Under 50.
Under 50, I'm sorry. So that is a good question. I do not know the answer to that. But we do have a compliance manager on staff here, and we can find out the answer for you on that. So we'll make a note of that. It's actually a good question.
The next question, what is the difference between full-time employees and equivalent?
Well, remember, a full-time employee is a full-time employee over 30 hours a week. Now, if you're a full-time equivalent is not actually a person. What you would do is you need to add up, there are different methods to measure this, but in essence you're measuring up all the hours that your other employees, your part-time employees work, and then from that you calculate your number of FTEs. So it's kind of like you're creating fake people out there to come up with your FTE number, which is just an equivalent of how many real people would be there as far as FTE. So they're really saying, okay, if you have 10 full-time employees, they're legitimate full-time, but you have 200 FTEs, the government wants you to recognize that you can't really get around too much of the law by hiring part-time employees. So that's really what they're doing. They're forcing you to react to having a lot of full-time employees and therefore say, well, in essence, if I have 200 part-time employees, then maybe I have an additional 30 actual FTEs. So that's why it's there. It's a calculation rather than actual people.
The next question, if an employer goes over 50 employees mid-year, when does their reporting start?
Right. Again, there's some nuances there, so that would be something I want to cover offline. And it depends on how you count your look-back period and how you count them, several different things. So, again, we will reach out to the questions, or you can call in, or we can reach back out to you to cover the specifics.
Okay, the next question. We have 11 full-time employees and provide employees with a UPMC PPO plan with a deductible.
Right.
The employer pays 100% of the deductible and 100% of the employee's insurance premium. Does paying 100% of the deductible make this plan a self-insured plan and susceptible to Code 6055?
No, it does not. The word self-insured means you're taking legal responsibility for paying all claims. When you have a deductible product, what you're doing is shifting some of the cost to your employees, but not all of it. And you are still insured by an insurance company, and therefore you are not self-insured.
The next question. We have 3 full-time employees that are laid off. We had previously paid their full insurance premium. Once laid off, we gave them the option to pay or cancel. Does this require special reporting?
There are some special reporting requirements that are addressed in the section 6055 and 6056 regarding COBRA employees, which I assume that's what you're talking about. If you're talking about COBRA, there are ways that you have to report those, and so the answer is yes. I won't get into the details here, but it is addressed in the section.
Do we have any more questions?
Okay. Well, I want to extend a thank you to you for spending, upwards of an hour with us, or at least a half an hour with us to learn more about this complicated subject. Again, we do have another webinar coming up, and that is on, May 13th again at 10 a.m. I encourage you to attend, and I thank you for your attendance today. Have a great one.